Welcome to Investment Ideas. I am the host again today, Ed Harrison. I am talking to Andreas Steno Larsen, who's the Chief Global Strategist at Nordea. Andreas, welcome back to Real Vision.
Thank you so much.
Literally 2 seconds before I started that introduction, I was saying that we have a different view than we've had before. Before we've been live. Yeah. Now this is the investment ideas. I think this gives us the scope to actually talk about a lot more than we've talked about in the past. So I'm looking forward to that.
Me too. It will be a great show.
Yeah. And, in the past, you and I, we've talked a lot about currencies. And today we're going to talk about the full gamut. But before we get into individual asset classes, I'm going to ask you the question that I posed to you via email, which is, if you had to pick a toggle at this particular point in time as we exit lockdowns, as we move towards a global reopening, what asset class is the toggle upon which everything else is dependent?
I think the dollar is the most important thing to watch. And the dollar is always the key for asset allocation. It's particularly the key for people outside of the US, but of course it's also important for people in the US. But if the dollar turns in a violent way, then there is no doubt that we will have repercussions across all sorts of asset classes. So therefore, I'm watching the DXY index with both of my eyes into the summer, no doubt.
Yes. And, by the way, that's a very good international take. I think that when we think about the dollar as the toggle, it tells you that a company like yours and you as the chief global strategist, you're thinking internationally. You're talking about across different asset classes and across different geographies. What's your view on the dollar and why?
I think we will see a dollar returning to strength during the second half of the year. And the simple reason is basically that the US will outperform right about every peer this year, not least due to the vast amount of thrust we've seen from the fiscal stimulus, both from the Trump administration, but also from the Biden administration. The scope of the fiscal stimulus that we've seen in the US is just massive. Also, if you compare it to all peers, even the Anglo-Saxon friends in the UK, they haven't been able to follow fully suit. So, you cannot find a bigger fiscal stimulus package anywhere in the world. And that's basically a reason to expect the US to outperform right about everyone.
Right. And, I see a chart that you produced that's shows the DXY versus the G9 in terms of the growth expectations 12-month forward on a 3-month annualized return. I believe that's what I'm looking at. Yeah. Talk to me about that chart and also the light blue line just going stratospheric in that chart.
Well, what I did was basically I took the expectations for growth in the US, and then I deducted the expectations for growth in the other G9 countries. And what we see right now is a massive move towards expectations moving in the direction of the US outperforming all of the peers. I would say usually that should transfer into a strong story for the US dollar, since it basically means that we are moving in the direction of very, very...
Hi, I'm Raoul Powell. Sorry to interrupt your video, I know it's a pain in the arse, but look, I want to tell you something important. I can tell that you really want to learn about what's going on in financial markets and understand the global economy in these complicated times. That's what we do at Real Vision. So this YouTube channel is a small fraction of what we actually do. You should really come over to realvision.com and see the 20 or so videos a week that we produce of this kind of quality of content, the deep analysis and understanding of the world around us. So if you click on the link below or go to realvision.com, it costs you $1. I don't think you can afford to be without it.
I would say usually that should transfer into a strong story for the US dollar, since it basically means that we are moving in the direction of very, very strong domestic growth in the US, not least. And what we've seen before basically over the past 10 years, I would say this correlation has been very strong, is that we see the growth momentum moving first, and then we see the dollar moving with a short time lag, but with a time lag. So there's still sort of a time period between you see the repricing of the US growth expectations and then the actual move in the dollar. So I still feel fairly confident that we will see a spillover from this whole positive repricing of the outlook of the domestic economy in the US to a stronger US dollar during the second half of this year.
So the questions in terms of that particular chart are obviously, since it's expectations, about how valid those expectations are in terms of what actually occurs. And then the second question is policy, the policy mix, and whether or not that has any impact on the actual outcome, both in the United States and also in the G9. What's your view on both of those questions?
I think George Soros said that if you have a loose fiscal policy, but a tight monetary policy in relative terms to your peers, then it's a strong story for your currency. And I tend to agree with that view. So the discussion ahead of summer is obviously whether the Federal Reserve will react to this massive growth momentum that is upcoming in the US. I feel very certain that we will see this growth momentum coming. And if I'm right that the Federal Reserve will react to this via a tapering process much earlier than people anticipate, then you have the perfect mix for a stronger dollar. You have a strong fiscal stimulus, you have a strong growth momentum, and then you have a tightening of the monetary impulse versus peers. And when we look to the other side of the coin, for example, in Europe, if we take euro dollar, then we know that there is a German election in sight in September. Right now, if we look at the polling, then the Green Party is ahead of the Christian Democrats who are currently running the country. And if they get a majority and if they are actually able to form a government, then I would argue that we will see a German catch-up to what we've seen in the US over the past year. So a massive fiscal stimulus. And the first reaction from the currency market when that happens is to sell the euro.
Interesting. Yeah. And there are a lot of places that we can go from this. Fiscal, we can talk about fiscal in particular. But one thing that you said that I found very interesting was that, the Fed is going to react. And so when you said they say the Fed's going to react, immediately I think about bonds, because what we saw is 90 basis points to as high as 177 in Q1 of 2020 for 10-year Treasuries. Now we've retraced a lot of that. We're in the 150s, low 160s trading range. It's almost as if people have given up on the concept that the Fed is going to taper. Have expectations changed in some regard because the Fed's been telling people, no, we're not going to taper. It's par for the course. You and I were taping this literally right before the Fed is going to give their next FOMC announcement. What do you think's happening there?
I think the Federal Reserve is clearly behind the curve. And they are deliberately behind the curve. They tell us that they want to see the actual progress. They don't want to rely on forecasted progress, which obviously means that we need to see 3-4 months in a row with inflation way above target. We need to see 3-4 months in a row with 1 million jobs created in the non-farm report and all that stuff before they actually feel comfortable with doing anything at all. But I still think that's in scope for this summer. Since we basically know that inflation will print above target over the next 3 to 4 months, that's a given. But I think the dark horse here is the labor market. We know that there is still a big sort of lack in the labor market compared to levels we saw of employment before the COVID crisis. But if we just extrapolate the trend that we saw from March, almost 1 million jobs created in 1 month, then we will actually be back at full employment before New Year's. I think that's a pretty solid scenario for the economy, that you will be back at full employment maybe 1.5 years after a crisis started. No one would have dared to say that in March and April 2020. So I'm still fairly optimistic that the Fed will actually be able to obtain both parts of the dual mandate by the late part of this year, and therefore they need to taper before that.
And all of this is really interesting because the Fed's going to speak today. The way I'm thinking about it is in terms of the Fed's liftoff from zero and the credibility of the Fed in terms of paradigms. If you go back in Fed history to Greenspan, what you saw was a Federal Reserve which said, you know what, actually, when we think about the non-accelerating interest rate of unemployment, we're not necessarily getting it right. Let's wait. Let's let unemployment go a little bit lower and see what happens. And so successively from Greenspan to Bernanke to Yellen, that's what we've seen. And Powell, he seems to be saying the same thing, almost to the point where he's saying that employment comes first and inflation comes second in terms of our dual mandate. But when you look at what actually happened under Powell, as we transitioned from Yellen to Powell, the Fed was the only major central bank of the G3, let's call it Japan, Europe, and the US, that came off of zero. We didn't even hit our 2% target for PCE inflation, yet the Fed raised rates multiple times before they were forced to cede to the markets. That doesn't speak to a Federal Reserve that really believes in waiting until it sees, the whites of the eyes of whatever they're looking for. How do you interpret that in terms of what the Fed's going to do now? Has anything changed? What are you thinking about in terms of what the Fed is going to do, given that their credibility is somewhat damaged with regard to waiting it out?
I think they mean business when they tell us to wait until inflation is actually printing above target. So they will already be tested on this quarter, since I feel very certain that we will get the PCE deflator above 2% for the quarter running, and therefore it's a very early test of that new average inflation targeting regime. I guess when the Fed launched this regime in September 2020, they didn't expect us to talk about the end of this regime already now, and therefore I mean they are fairly firm that we need to see this inflation regime actually occurring before they do anything, but it will occur right in front of us. So it's a big test of the Fed already this summer. And my point being that, as you also mentioned, if the Fed is okay on the inflation front, and I guess they will be okay on the inflation mandate already this summer, then there is no reason not to taper. Because the labor market will start running hot much sooner than people anticipate.
Right. And so this gets to the whole your whole view of bonds. You've told me that you are tactically bearish on bonds. Talk to me about why and what trading range you see bonds trading within, and over what time frame.
I think we will see what I call an average inflation targeting tantrum already ahead of the summer. So, I mean, it's of course a word I've stolen from the spring of 2013 when Bernanke mentioned tapering the first time, the taper tantrum. But this time around, the Fed will actually have to do something when inflation prints clearly above 2% 3 to 4 months in a row. Powell promised us to elaborate on the average inflation targeting regime as soon as inflation actually prints above. And that will basically occur already by the June meeting. And therefore, I think stakes are very high ahead of that meeting in mid-June already, since Powell will have to elaborate when is moderate overshooting obtained. And therefore, there's clearly a risk of a bond sell-off into that meeting, since everybody will expect him to clarify it already then. When we get the clarity that inflation is running way above target by June. So target-wise, I'm looking for above 2% in the 10-year Treasury yield already by mid-June. I know it sounds aggressive right now since we've had sort of a softening of the momentum. But if I'm right that we will have this tantrum into the summer, then I don't think it's out of this world to think of plus 2% in the 10-year Treasury yield already by then.
I want to go international. So let's hold on that thought. But the immediate thought I have is when you talk about plus 2%, that's not really a very positive scenario for equities. Sell in May and go away kind of thing. What's going on there?
Well, I think you're right that there is a clear risk that equities will suffer this scenario. The first thing that will happen is that the expensive parts of the equity market will suffer, and then we will probably get a more broad-based sell-off into the second half of the year. I think that's likely. We already see what I call the canaries in the coal mine in the equity market. We've seen a tendency for small caps to underperform again over the past month. We see a tendency for underperformance in emerging markets. That's also a canary to me. And those are what I would say early indicators of a broader sell-off in equities. I'm not saying that it's going to be violent, but I surely won't bet on equities printing higher 1st of September compared to today.
Before we go international, let me think about some of the charts that you sent me in anticipation of this call. I'm thinking about the chart that you have about the federal budget balance and current account balance, and then the CBO forecast, and also what it means in terms of the dollar, since this is the toggle that we're talking about that is driving the asset allocation cycle across the world. What is that chart telling you?
Well, I guess the big question is whether a huge fiscal deficit is good or bad for the dollar.
Right.
I told you earlier that my guess is that it will be positive for the dollar this time around, since the US will outperform all peers growth-wise. The other interesting thing is that other peers are moving towards future fiscal deficits this year. I think Germany is a good example of it. They are slower to react to a crisis than the US is. And therefore, we will get peers moving towards larger fiscal deficits this year. To me, it's kind of old news that the US is running a huge fiscal deficit. I mean, that was a 2020 story. The dollar weakened as a consequence, fair enough. But the next thing now is that the US will reap the benefits of this fiscal deficit from 2020. All of the growth stimulus that we will see this year is a consequence of what happened in 2020. All of direct transfers will start influencing the US economy in a positive way. And therefore, I mean, if I need to be forward-looking as a strategist, and I think what's going to happen this year is that Germany will start to play a catch-up game with the US. Will start spending more, which is an issue for the euro, while the US side of the equation will start reaping the benefits of the fiscal deficit from 2020.
Yeah, I think this is a good segue into what's happening in Europe and thinking about the bonds and the euro in general, because it's interesting when you mention Germany. When you think about 2020, Germany actually ran the biggest deficit that they've had since reunification. So we're talking 3 decades in 2020, a 3-decade high in deficits. And you think back to the regime of Schäuble and Merkel, and you're thinking about they're cracking the whip on the likes of the of Spain and Italy and Portugal. Actually, I've heard that the Germans have mentioned something about the Spanish getting their fiscal house in order already. So, I'm wondering, are we in a new era? For a long time, I would say 4 decades, we were in the era where we said that, okay, monetary policy is the toggle. But now it seems that a lot of people are saying we can actually do things with fiscal policy. But how far are they willing to go? How far are the Germans willing to go for themselves? And how far are they willing to go for Europe as a whole?
It depends a whole lot upon who's running Germany after the September election. If the Green Party is in charge, then I would expect Germany to go fiscally bananas in a way that you've not seen Germany doing fiscal stimulus in decades, as you mentioned. So this is a big game changer. I already think it's a big game changer that you see a clear breach of the Maastricht rules in terms of the fiscal deficit in 2020 in Germany. I mean, they've had black zeros as the strategy for the budget for years, and even going to -5 to 6% of GDP for the budget is a big thing in Germany. But they are still so fiscally conservative that it almost hurts if you compare it to the Anglo-Saxon deficits that we've seen in 2020. So it depends a whole lot on the situation after the election in September, and I would put my money on a regime shift politically after the September election. I think the left wing will win.
Right. And so when the left wing does win, what kind of combination government does that involve? Because the SPD is weak. The CDU might be weak, but they're not that weak. Could it be, Green, High Democrat, and CDU, CSU?
The most likely combination is basically the Green Party, the Social Democrats, and the Liberals. And right now, if the polling is correct, then they could actually form that coalition. Whether the polling is correct is a tricky question since we are so far away from the actual election date. But if you look at momentum, then there's no doubt that left-wing parties are gaining across the board in Europe. They've had the best sort of answer and response to the COVID crisis, at least in the eyes of the public. And I suppose that we're not out of this mess by September, not least when you're watching the pace of the vaccination rollout in Europe.
It's interesting there because of Italy, because I would argue that Italy is where the rubber hits the road. Now we have the technocrat Mario Draghi in there. Yeah. And if you listen to the things that he's saying, he's basically saying, this is a task for Europe. It's almost like he's saying, we're going to go green. Some of that's going to be deficit spending at the level. Me, I'm going to make sure that we do the structural adjustments, but we need you to go easy on us in terms of austerity, and B, we need at the EU level, we need some juice. Do you think that in a world in which the Green Party is running the show in Germany, that is a possibility both for Italy at the state level and also for the EU at the EU-wide level?
We're definitely headed in that direction. The debate has changed a whole lot in Europe compared to pre-COVID discussions. And I think it's a much more feasible scenario now that Southern Europe is basically allowed to spend the way out of the crisis. And I think if you look back to 2011, there are clear lessons to be learned in terms of how Europe tackled the huge financial crisis we had in 2008, 2009. Europe entered a new crisis basically below 24 months after the first crisis due to the tightening of the fiscal policy and due to the tightening of the monetary policy at the same time. This will not be allowed to happen again. And therefore, I'm basically in the camp of more fiscal stimulus in Europe and in the camp of this being a clear regime shift in how the European Union conducts fiscal policy, first and foremost.
And so I think when you talk about the regime shift, there are two thoughts. One is on the relative strength of the euro and bonds in Europe. And the second is with regard to that first chart in terms of the U.S. impulse moving up in terms of the lag and what impact that has on European assets. Let's start with the lag in terms of European assets. Europe's behind on the vaccination. You're talking about the fiscal impulse happening later, much later actually. If September is when we get that clear definition from Germany, what does that mean in terms of the U.S. versus Europe? How do you play that?
I mean, from a tactical perspective, I would clearly overweight the U.S. versus Europe this year. due to the clear outperformance of the US. But there is a scope in 2022 and 2023 for a catch-up in European assets, since the European Union is slow-moving when it comes to fiscal policy. We've already seen how this new stability fund in the European Union is a slow mover. My assumption is basically that we will hit sort of the peak fiscal stimulus from this new fund by 2023. It takes a whole lot of time in the European Union to get projects accepted. For example, when you apply for money in this fund, because you need to send an application to Brussels, then the European Commission needs to review it. Then there is sort of a process back and forth for a while, and then once you actually get started on the new bridge or whatever you've applied for, then the calendar probably reads 2023 or so, right? So it's a very slow-moving process, but there's a lot of money in scope, and I think it will be distributed over 2022 and 2023. So there's a catch-up effect to be expected, but this year I will clearly go with the US.
Yeah. And, in terms of the U.S., I think the dynamic that's playing out just from the fiscal deficit perspective is interesting. And I'd definitely like to get your take on this, because the take that I have is that Biden is a old school Democrat. And when I say old school Democrat, actually, I mean the new Democrats of the Clinton ilk, which were very much into fiscal responsibility, meaning they don't want to be seen as people who are deficit spending, that he wants to close the deficit. And so literally today, he's going to outline his plan, which I would consider a plan that is going to do the fiscal spending, but then look for places where they can tax in order to minimize the deficit. And those places include the capital gains tax. It includes carried interest tax. It includes potentially the estate tax, and it includes company taxes and taxes on the rich. Do you think that that has any impact in terms of thinking about relative deficits in the U.S. and the rest of the G9?
Well, I'm not sure I agree to your analysis on Joe Biden. I would argue that it will be very, very difficult, for example, to take away direct transfers to households again. I would argue that we are moving towards a de facto universal basic income regime, since the left wing of the Democrat Party has never been more powerful than currently. And therefore, I also think that the US will run a big deficit in the years ahead, probably also worse than what the budget office currently projects. Of course, there is a scope to increase taxes on the rich. I'm not sure that's a particularly forceful instrument. I also saw that, I think Biden said earlier today that they will try to collect more taxes given the current tax plan as well. I mean that's something only a politician can say, right? Because that will never happen. But otherwise, I actually think that the instruments that they have in the toolbox tax-wise, they're not particularly effective. It's not effective to increase the taxation on corporates either. So I don't think the deficit will be closed, but it's basically just signal policy if you want to tax the rich part of the population more, and if you want to tax the corporates more. It doesn't really work.
Right. So you think that he's going to signal that I'm going to close the deficit, but he's actually not going to be able to do so.
Yeah. I mean, the way that he will actually be able to close the deficit is by closing the employment gap much earlier than people anticipate. I mean, that would be sort of the real way of doing it. And I think there's a scope for that, given that I have such a bullish view on the employment market. But otherwise, in terms of the toolbox on taxes, then I don't think he has a scope for it.
I would say my piece in that, if you look at Ronald Reagan as an example, where it's a different story, where he decided to lower taxes and increase defense spending and had a huge deficit. Eventually, that gap got closed, both under Bush via higher taxes, and then later under Clinton via growth and higher taxes. So I would say that eventually the deficit's going to have to be closed in all likelihood. And the real question is over what time frame and what that means for assets. But at a minimum, all of the mooted taxes are taxes that are negative for U.S. dollar assets, U.S. Equity assets. Do you think that's going to have any impact on markets, on U.S. equities in particular?
I think there is a clear risk that the Biden administration over time will be a business aggressive administration, in the sense that they will actually increase taxation on the wrong parts of the economy. And I think that scope is in play for the years ahead, but I'm not sure that it's a scope that I buy into for the tactical period ahead of us. They have already used the reconciliation method for the last package, and therefore they will probably have to save those tax increases for the next fiscal year. So I'm not sure that it's a story that's super relevant for 2021, but I certainly buy the risk that that Biden will what I call bananify U.S. assets over his administrational period.
When you mentioned bananify, I mean, I think to the U.S. dollar, and you have a bunch of different charts that you showed me, and I was thinking about what's the segue into talking about the U.S. dollar as a reserve currency, and there you have it right there. So let's talk about that. The U.S. dollar as a reserve currency. The first chart that I see in that whole bit is the chart which shows the U.S. dollar as a percentage of reserve assets. And let's call this chart the one where we're thinking about digital yuan and Bitcoin. Talk to me about that chart, and then your question at the top of that chart, which is about Bitcoin and the digital yuan as potential game changers.
Well, I mean, it's of course been a hot topic for years whether the U.S. will be able to keep the dollar as the number one reserve asset in central banks across the world. And if you look at the trend, it's clearly sloping downwards, right? So there is a slow process already on the way towards diversifying away from the dollar in reserve portfolios across the globe. I'm not saying this is a rapid move yet. It's clearly not, but there are. The trend is clearly your friend in this case, that the dollar is slowly but surely losing its status as the reserve currency. But I don't think it's a short-term story again. But my eyes are firmly focused on what's going on in China, since they are within maybe a year of launching the digital yuan. And just when you're watching the hype around digital assets in general, then I would also suppose that you should expect a hype around the digital yuan once it's launched in 2022. So for that sheer reason, I think there is a risk that the dollar will lose some status once we get the digital yuan going. And remember that China is front running right about everyone on this topic. I don't think Bahamas launched a digital currency yet, but otherwise other peers in Europe, in the US, and across the globe, we're running way behind China on this topic. So I think this is the greatest risk that we've seen for the dollar reserve status in decades. I don't think Bitcoin is that big a risk, but I think the digital yuan is a big risk for the dollar reserve status.
Yeah, interesting. First is the time frame. Over what time frame are we talking about? And then the second is about this part about the digital yuan versus Bitcoin. Why is it that the yuan is, which, and by the way, that's not a convertible currency, because they have capital controls. Why is that the currency risk for the US dollar?
First of all, I basically think that the Chinese authorities have promised us that with the digital yuan, easier capital rules will follow. So that's one thing to bear in mind. The second thing is that the yuan will likely slowly but surely be used in more transactions in at least intra-Asian trade. We know that China is now basically the sole regional powerhouse of the Asian economy, and therefore it makes a whole lot of sense from an incentive perspective for neighbors to start using the yuan to a much larger extent in terms of trade. And that's an important prerequisite when we're talking about a reserve currency, that you simply need trade to be conducted in that currency for it to be of good use in a reserve portfolio. And that's the big issue for Bitcoin, that it's not a transaction currency. You will never see central banks buying Bitcoins for the reserve portfolio as long as it's not a transaction currency. And therefore, that's sort of a big difference between the digital yuan and the Bitcoin.
And, the Chinese authorities have said that for 2021, 2022, maybe even, our focus is on the domestic front. We're going to roll this out and do stuff with it that is domestically focused. And only afterwards are we going to talk about trade and other sorts of things. Do you believe that? And what time frame do you think that they are going to start thinking about bilateral trade in digital yuan?
Well, we know that China will host the Winter Olympics in 2022. And my best guess is that it's the perfect setting for them to launch the digital yuan. So by winter 2022, I would expect them to be ready to launch this, and also to sort of utilize the digital yuan in bilateral trade facilities. So it's not that far out in time, right? I know it's not a story for this year, and probably not a story that markets will care a whole lot about this year, but it's definitely within a 5-year time horizon that the digital yuan will start challenging the dollar.
Right. Now, there's the potential of conflict between the U.S. and the Chinese by that time. I even hear people talking about boycotting the 2022 Winter Games in the U.S. Do you think that's going to happen? And if so, does that make any difference in terms of their launching the digital yuan?
I think if markets have told us one thing since Biden took over the Oval Office in the White House, then it is that the Biden administration will turn much tougher on Russia, but they will ease restrictions on China compared to the Trump administration. I'm not sure that they will be that China hawkish. I think that they have acknowledged that the trade policy of Trump was not for the greater good. And I also think that they've acknowledged that the trade policy of the Trump administration made the US suffer in all sorts of diplomatic ways in the rest of the world. And that's why we've seen markets trade the yuan in a positive direction basically ever since Biden took over the lead in opinion polls.
Right. Now, I want to go back to some of the other things that you have chart-wise that are relevant here, especially with regard to reserve currency and also potentially with regard to interest rates. The next thing that's on my mind on that front is the federal holdings of Treasuries as a percent of the total market, and then the Fed holdings of the Treasuries as a percent of the Fed and the foreign holdings as a percent of the total market. What you see, ever since quantitative easing has gone about, is that the Fed's percentage is going up, and we've gotten to a point now where the Fed holds as much assets as foreign buyers of assets. What does that do to the dollar, and what does it do to interest rates?
Well, the first thing that happens when the Federal Reserve takes over a bigger part of the market is that it gets increasingly tricky for foreigners to be part of the market. We've also seen the same trend in other countries with a very activist central bank in terms of bond markets. So the point is here that when you basically decide to buy a bigger part of the market, then you also decide that foreign central banks will not be as big a part of the market. So it's slowly but surely also pointing in the direction of the dollar being a less relevant reserve currency than it was earlier. The most important thing for a reserve manager, for example, in China or in Europe, is that you have a well-functioning liquid bond market that you can invest in with the reserve currency. And when the Federal Reserve takes up a bigger portion of the market, you slowly but surely compromise that functioning of the market, but also you slowly but surely compromise the dollar as a reserve currency as a consequence.
Does that have any current account balance implications? Because basically, you can think of the foreign central bank holdings of Treasuries as a way of, dealing with their current account surpluses with the United States. They're going to hold them in some U.S. dollar asset.
Yeah.
What happens when the Fed is buying up all the Treasuries?
Well, they're simply pushed towards other assets. Probably, if you look at it very practically, the first thing that happens is that the central banks in foreign countries, they are forced towards other dollar assets. But over time, there is no practicality that ensures that they are not selling those dollars and buying assets in other currencies. So I know that there is, given the current account, a running flow. But if you look at, for example, the Chinese holdings of dollar assets, then it's pretty clear that even with the massive money printing we've seen in the US over the past 12 months, they haven't increased positions in US Treasuries as they would otherwise have done, since they have received a lot of dollars due to the trade deficit, the current account deficit of the US versus China. So first thing that happens practically is that they buy other dollar assets. Second thing that happens is that they sell the dollars.
Right. And, by the way, you did have a chart on the holdings of Treasuries by China, the yearly change on change. And then you juxtapose that to US dollar excess reserves. So that's a slightly different comparison. The interesting bit is that the two seem to move in tandem, except for recently there's been a massive increase in US dollar excess reserves, but there hasn't been that year-on-year increase in the Chinese holding of Treasuries. What does that particular dichotomy signal to you?
Well, the reason why there is a historical correlation between the increase in dollar excess reserves and the holdings of Treasuries in China is that when the Federal Reserve prints a lot of new dollars, the increase in excess reserves, then there is a tendency for the dollar to weaken. So it also allows local central banks to increase the foreign exchange reserves during such a period of time, since the dollar is weak in general. It allows them to build up the reserves, and therefore they automatically invest more in U.S. Treasuries. I think the reason why we haven't seen a connection between the two time series this time around is that the manipulation of bond markets was simply so big from the Federal Reserve in Q2 and Q3 last year that it was impossible to get a bigger stake in the US Treasury market. They simply bought more or less everything, right? And much more than what was issued. So the Chinese authorities simply had to find other dollar assets to buy, and maybe even they had to sell the dollars.
That manipulation of the market by buying up everything that moves, that obviously can't happen in a vacuum. That must have negative external consequences. I want to know what those consequences are and to what degree that's going to impact the Fed's move toward announcing how it's thinking about average inflation targeting.
Well, to give you a very practical example of the repercussions, the Swedish central bank close to where I live, they have bought up more than half of the market. In some parts of the Swedish government bond curve, they even own 2/3 of it. And the practical repercussion for them is that reserve managers in other central banks, they've started to look elsewhere for reserve currencies. The Swedish krona simply suffers from this, as it is impossible to find something to invest in with your Swedish kronas in the reserve portfolio. And I think that's the clear risk. If the Federal Reserve outprints the issuance from the US Treasury, then the bond market will simply shrink in size, seen from a foreign perspective. which is a bad thing if you're an FX reserve manager in China. Then you want a big and liquid bond market. And currently, the market is moving in the wrong direction in terms of those characteristics. So that's a very clear practical repercussion. This will lead to a smaller portion of dollars in reserve currencies across the globe.
And has the Fed thinking about that? And how does that affect their average inflation targeting goals?
Well, inflation matters more than this. And as long as there are no market functioning repercussions of them buying a large part of the market, then I'm not sure that this is a big issue for them. If you look elsewhere, for example, in Japan, we know that the liquidity is fairly poor in Japanese government bonds compared to decades ago. But I'm not sure that Bank of Japan find that it's a big issue, since the yield curve is fairly stable anyway. So I mean, if interest rate markets are not moving in a volatile way, then why should the Fed care about it? I don't think they will.
Yeah, very interesting, I have to say. And you were saying that they're more interested in inflation. What are the signs of inflation in the U.S. economy? If you look at, say, job openings, compensation, things of that nature, what are they telling you?
Well, for the first time in many, many years, I'm actually starting to believe that we will have a lasting wave of inflation. First point being that the policy mix of 2020 was a big regime shift compared to the decade that we have passed us. First of all, we got a redistribution mechanism in place for all of the dollars that were printed by the Federal Reserve. So if you look at the amount of fiscal transfers to households, then it's actually almost a one-to-one match with the dollars printed by the Federal Reserve. So the Federal Reserve printed dollars, but the US Treasury actually redistributed those dollars directly to households. I think that's an inflationary game changer compared to what we've seen over the past decade. Because over the past decade in QE 1, 2, and 3 from the Federal Reserve, they basically just bought assets, but there was no mechanism in place to ensure that the money actually reached the real economy. And I basically think that Trump and Mnuchin should be celebrated for this decision. It's a good decision, and it's a decision that will lead to a very swift rebound in the labor market. And it's a decision that finally will allow workers to gain wage competitiveness against their employers. So we also see that from anecdotal evidence right now. Fast food chains, they struggle to hire people at the moment. They even need to offer bonuses, and that's usually not been the case over the past decades. I mean, workers in fast food chains, they haven't really got a real growth in income over the past decades, but now they will actually get it, I think. So this is a major game changer.
Right. And let's wrap up with one or two other asset classes that we've missed. I'm thinking commodities, gold, et cetera. And then maybe you have some final thoughts on things that we've missed beyond that, especially with regard to Asia, with regard to emerging markets, and to a degree, Europe, though we covered Europe in the beginning. But I know when you talk about inflation and you talk about compensation, I think about commodities, because that's the first thing that we see popping up in terms of inflation now. And in addition to that, when people have more money in their pockets, they have more money to spend, and commodities are going to benefit from that. Especially green commodities. People talk about copper as an example. What do you see in the commodity space? What do you see in the oil sector? And how does gold and other precious metals, how do they react?
Well, I mean, this potential super cycle in commodities, I tend to buy it, but I buy it more on a tactical level than on a structural level. It's it's very clear that we have a strong trend in most commodities at the moment. I still think we need to look at least a couple of decades back to find as uniform a trend in commodities as we see right now. And I think there is a tendency towards sort of a vicious circle here, in the sense that you want to be long commodities when there's an inflation risk, because it's the best way to hedge against inflation. And therefore you have sort of a vicious loop that every time commodities start increasing rapidly, then people tend to buy commodities as a hedge against an increase in prices overall. And I think that doom loop is pretty much what we're experiencing these quarters, and also the reason why we see such rapid moves. But doom loops tend to end with a big bang. And I think the big bang here is China. China is clearly stepping on the brake now. The big question is whether they will re-accelerate the economy due to the COVID spread that we see in neighboring countries right now. I'm not convinced that they will do so, since the domestic economy is running really hot in China by now. And therefore, once we get closer to 2022, then you may get some super opportunities to short commodities again, broadly speaking. And by that time, I would enter gold longs again.
Interesting.
Yeah.
So you're not gold long now, no. Right?
The reason being that if the Fed tapers ahead of schedule, so to speak, then it has to be a negative story for gold, since gold is so reliant on this ultra easy monetary policy forever. So it's only from a very tactical perspective that I dislike gold. I'm usually perma long gold, but right now I would actually scale down on it.
And what about palladium and platinum in particular? I know palladium has been seeing a huge bid.
Well, palladium is also linked to what we see on the transmission towards zero emissions on carbon, and therefore it's a good structural trade, I guess. Since it finds so much use in the battle against the climate changes. So I would actually be structurally pretty upbeat on that. I'm not sure I have a strong view for the very short term, but structurally it looks like a good story still.
And so now what are we missing? I think it's been a pretty comprehensive conversation, I have to tell you. But what's, if you had to sum up in terms of how you're thinking, first do that, but then also where are the bits and pieces that we haven't focused on that people should think about once or twice?
Well, to sum up, I would build my portfolio back better, to use a Biden idiom, by being long the US dollar into the second half of the year. I would still expect the US to outperform all peers this year. So it's also a good story for US assets compared to European assets, for example, in equity space. But what are we missing? Well, I think what we're missing, and what most people are missing still, is that inflation will be a lasting story this time around, since we have introduced policy measures that are basically impossible to get rid of again due to the very nature of a democracy. Once you've introduced direct transfers to households, then it's impossible to take it away from people again. And therefore, I actually think that we are slowly but surely moving towards a de facto universal basic income. And oh boy, it will be important for assets over the next 10 years, not least from an inflationary perspective.
Yeah, that is a big miss. I think that's the elephant in the room. So when we come back and talk again, we're going to talk a lot about that universal basic income and what the, let's talk long term, what that means.
Yeah, that's a very good idea.
Thanks again, Andreas. I appreciate your coming on, and look forward to talking to you again soon.
It was a great pleasure.
I hope you enjoyed this special episode of The Interview, the premier business and finance series in the world. However, this is just the tip of the iceberg. For more in-depth content and expert analysis, visit the membership link in the description to unlock a week's access for only $1. This dollar can change your life.